welcome. It's Sarah Larby, guest host and producer of Everyday Investor, where we show you how your money can make money, whether it's stocks, options, real estate, and there's lots of different strategies. This is going to be the place for you to get your information, your knowledge, and build your team of solid professionals along the way, whether they are lawyers or coaches or people you just want to connect with. So we've got lots of great guests. Don't go anywhere. Coming up, we are speaking with Anthony Maniaca from Maniaca Law about everything you need to know legal perspective-wise on real estate investing.
You know, I have to say, this is probably the best or the silver lining within this sort of economic downturn that we've seen. It's that you're allowing your clients as buyers to protect themselves.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commissions. Head over to our website, everydayinvestor.com, to find out more.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Hey, it's Kyle from the Kyle Ford Mortgage Team. This week I want to talk about financing properties, investment properties specifically, with less than 20% down. As many people know, it's quite common to buy a primary residence with 5, 10, or 15% down. But when it comes to buying an investment properties, the industry standard is 20%. At the Kyle Ford Mortgage Team, we specialize in helping investors purchase properties that are more difficult to qualify for. Often we are able to get financing at up to 90% loan to value, which is a 10% down payment, by using private money. Now, this doesn't work for everybody, but if you're buying properties that need work, have significant upside, or have a clear exit strategy, we can help you acquire with less money down. If you have questions on how this works, don't hesitate to reach out to myself and the Kyle Ford Mortgage Team.
Anthony, welcome to the show. How are you doing?
Fantastic. Thanks for having me.
I'm excited. I love this topic, all about real estate from a legal standpoint and what we need to know. There's lots of changes in the market. There's lots of talks about the interest rates going up, and there's also lots of talks about deals falling apart and all of that stuff. So what are we seeing, or what are you seeing from a real estate investing legal standpoint out there today?
Well, I will say this, as a buyer, it's become much harder. Across the board, everything that you have to do in order to ensure that your due diligence is met and you do all the things you need to do to protect yourself. Mm-hmm. But the good thing about being a buyer in this market is it's your market. Things have definitely sort of leveled off a little bit from the frothy nature over the last even decade or two. And so, you know, yes, we've seen a lot of things as you move towards and through the transitionary period of, you know, low interest rates and free flow of the real estate market into something that's a little bit slower, a little bit more methodical, a little bit more expensive. As we've seen, rates are definitely going up, and we're going to see them sit here or higher for the next little bit. So that's a big thing from an investment perspective, obviously, making sure that even within your ratios that you have, you know, factored in the increase in interest rates to, you know, as against your, you know, your cost to achieve a profit more than anything else.
Yeah, absolutely. I mean, I think, you know, personally myself, I've bought since March, since things have started coming down, maybe 8 deals, and we're getting better and better deals. But now finally, we can actually put clauses in our offers. Mm-hmm. So what are some, you know, clauses that you would recommend that somebody put now that they're able to make offers just to protect themselves?
You know, I have to say, this is probably the best or the silver lining within this sort of economic downturn that we've seen. It's that you're allowing your clients as buyers to protect themselves, whether it be through doing inspections on the property, making sure you've got your financing in place. And what I am seeing is, historically, there was always a condition that sort of allowed for 5 days, and then we moved away from conditions altogether. Now what has happened is the pendulum swung the other way, and we're seeing conditions more in the 10-day range because it's a lot harder to qualify for this increased interest rates and money for these deals. So if you're buying from an investment perspective, it's slightly more difficult. You have different things you have to do. Most importantly, you have to ensure you have 20% to put down at the time of the purchase, right? So we've seen a lot of things. You got to look for the silver linings within the market when it comes that way. And so, like you said, there are things that are definitely in the buyer's favor. So clauses that I like to see, obviously, as I've mentioned, are financing. Right. It's vitally important that not only that you get the financing, but you get financing that works. You could get financing at, say, 10%, but that doesn't work within your ratios, and you may have to walk from the deal because you just didn't qualify. So ensuring yourself enough time within the financing perspective is key. Second is inspections. My biggest pet peeve over the last little while as a lawyer is when clients come to me who are buyers and they provide me with these offers that were conditionless. And I explain to them, do you understand if there's leaks in the foundation, if there's problems with the roof, or whatever the case may be? Inspections catch those, but you haven't. Well, what do you want me to do? There were 6 other offers coming in and they didn't have it.
Right.
We've now moved back to that sense of balance that allows the buyers the time to ensure that they've done their appropriate work up front. Nowhere is that more important than as an investor. Every dollar counts. Right? So if you have to go in and start making repairs and fixes and do all these things that were not expected because you weren't able to factor that in at the time you bought, it could be a real problem for your investments. We've seen all kinds of other things that allow clients chances to go in if they're developing, say you're investing, but you're going to actually tear down the place, or you need a permit.
Right.
Some of the really important things that you have built in is that you're allowed to start working on those permits before you buy. So you want the vendor to then turn around and say, okay, I will help you in that endeavor and sign anything you need within reason to work on the permits as you go along. So there's various different things depending on the nature of the investment that you're making within the property itself as to what is and isn't important. But the key thing is we're back to a time where those clauses can be put in without any kind of issues.
I'm also finding too, like vendor takebacks are like a thing that are becoming more and more these days because people would rather, maybe stick to their price, but like change a little bit of the terms and conditions, and offering a vendor takeback in first or second is something that we're seeing come back. What are you seeing on your desk there?
So if you're going to be topping up on a second and somebody's coming, you need to make sure that the bank who's sitting in first position consents to that mortgage. And I would say 90% of the time that's not an option. Most banks don't want that. They want to see your skin in the game. They want to make sure that you've put enough equity in to reflect the risk that they're taking within it. So from that perspective, it's important that you're talking to the bank ahead of time to ensure. Now, if you are giving a vendor take back because you didn't qualify for a mortgage and the vendor is prepared to give you a certain rate or whatever, that's great. But I would always caution that you didn't qualify necessarily today. And when that mortgage comes due, what are you going to do to ensure that you qualify then? You do not want to be going back to them and they turn around and say, look, we're not a bank. We're not here to provide you with money. We helped you at the time of the purchase. Now it's time to move on. And you're left either scrounging, going to the secondary private money market, which is frightfully expensive. So the key is, and Rav will tell you this till the cows come home, when I come on the show and we talk, the number one thing I always say is do your work up front.
Right.
Period. So these are all things that literally play into that. You need to understand the lay of the land better today than ever because of the financing alone.
Right. Look at, the exit, maybe a secondary exit, have backup plans, back up to the backup plans. And, unfortunately, as these things happen, more and more people are going to start panicking. We're probably seeing it a little bit. One of the things I've always thought, like, again, everyone's got their strategies, but for me, it was always a little bit of a scary strategy, that hold, buy, wait, and assign strategy of people that are getting these contracts of, properties, and they're expecting the appreciation, and they're going to sell the contract for more. Because in a market that has some instability, to me, that's a high risk type of strategy. But I'd love to hear your thoughts on that.
So we're talking about the assignment of new builds?
Correct.
Is that okay? So yes, that is a very robust market. Absolutely, there are lots of speculators within that market hoping for the best, where you put down a certain amount and hoping for the return on that amount being realized through the increase in equity during the time of construction. You're 100% right. In this stable market, you need to be very, very careful. Builders have definitely built in a lot of that profit over time because they're starting to understand they're walking away from money. And we're also seeing builders actually walking away from deals due to the cost of materials, cost of financing, or otherwise. And so that's another thing that has become an issue, especially with my clients when they buy. First thing they ask me, so, can the builder do what I'm reading in the papers all the time about raising the cost on me or giving me my deposit back with no interest? And generally speaking, I would say the answer is yes. Those clauses have always been there. We just haven't necessarily seen them because the economy, when it's going up and up and up, nobody cares.
Right.
But as things falter, as we've seen coming out of COVID and pandemic times where cost of materials was so high and increased to a rate we haven't seen in a very long time, it really did put a strain on these developers. And I think that there's been moves made by government authorities to try and help pull some of those strings off, and we hope that will continue. My feeling is this: as with any investment, do your homework. Know the developer. Is it a fly-by-night? Have they been around? Who are the principals of the company? What does the world at large have to say? There's lots of forums and boards out there that talk about all of these builders, people's experiences with them, so you have to weed through some of that. But I think that it's a good place to start to better understand who you're getting into business with, because that's the thing people don't realize. You're getting into business with the developer because you're speculating on their investment, right? And so you really need to have a good understanding. And that's part of the problem. Sometimes with some of these investments, they seem too good to be true. And I always say, if they are, they are.
Right.
Right? But that's not to say that these developers haven't created a nice investment vehicle for people if they want. Right? You have good properties, and we have an influx of immigration coming to this country, big numbers, 1.5 million people per year if they can process that. These people need to live somewhere. So as a speculator, you may have to close, but you might be able to rent.
Right.
Rental prices are high enough that it should be able to cover the cost of things. So my feeling is this: do your homework. But it is still a nice avenue if you understand who you're getting into business with. And again, what we talked about previously, what your exit strategy is.
Some great insight, definitely, for sure. Now, usually they have a contract, and I believe it's a 10-day cooling off period. What are some things that is going to be part of their due diligence, in addition to obviously figuring out who the developer is and making sure that they're, this is not their very first project and the other ones have been successful and so forth. So they have this contract, there's 10 days. What are some things that they should be doing at that point during those 10 days?
So just so we're clear, new builds obviously come as condominiums or as freehold homes. Condominiums have the 10-day cool-off period. Freehold homes, it's slightly less. So you just need to make sure you're within that time. The first thing you do when you sign that contract is you take it to your lawyer. I've seen a lot of contracts that are coming up, the buildings are starting, that people are coming to me, they never had it vetted, they never had it looked at. And the thing people don't necessarily realize with new builds are all of the adjustments and additional costs that come at the time of closing. So those costs between park levies, other kinds of taxes, various different hydrometer hookups, insurance, Tarion insurance and so forth, they're all costs to you as a buyer. And they can be anywhere from $25,000 to $50,000 to $75,000 above the purchase price. So it's vitally important that you review and you understand the cost certainty, and that's where the lawyer comes in, because we will review it, we will go through the adjustment with a fine-tooth comb to make sure that where we can cap those numbers and have cost certainty, we can. Developers have become very good at doing that for us, in the sense where most agreements now have most things capped, so we're not dealing with a lot. We will go through other things that we may or may want to try and take out, but the one thing that I think a lot of buyers need to know, if they don't already know, is that the developers and builders are the ones who are in control. Their contracts are very, very difficult to negotiate. They don't necessarily want to change anything, and as a result, it's sort of take it or leave it. So you just need to understand your pitfalls. One being what we already talked about increase in costs of materials and economy and how that can affect that contract. including things like swapping out various different materials for equal or greater type materials.
Right.
So you may have asked for specific flooring, it's gone out of run for whatever reason and they need to do something else. They have the right to do that. I had one example where they had to change the elevation of a freehold home on my client's like, no, I wanted elevation B and they're giving me elevation A. And I went to them and I asked for an abatement of price and try and work on something, and the developer said, no, that's fine. We'll give you your deposit back. We have lots of buyers ready to take this property if you don't want it. So that's just one example of, it's very heavy-handed and it's very difficult. So you kind of have to know what you're getting yourself into. So the key when you're buying, whether it's freehold or condominium, is that you negotiate in there some form of assignment clause. That's where that speculation piece comes in, where if you're going to sell that contract to someone else prior to close, you need to have that right. And you need to know what it's going to cost. Most developers charge a fee. Sometimes you can negotiate that down. Their lawyers will charge a fee. That's a harder thing to negotiate down. So in the end, we just need to make sure that that's the case.
So it sounds like going to your lawyer as soon as you have the deal or the contract, or even maybe prior, just before you move forward and make something permanent, to have that lawyer review and help you and be by your side. And that's the importance of having the power team.
Absolutely.
And guys, don't go anywhere. We're going to be right back. We're going to talk to Anthony much more in more detail about everything legally that you need to know as a real estate investor. Stay tuned. Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey everyone, it's Ken Beekendam from LegalSecondSuites.com, and I want to talk to you guys today about garden units, garden suites, laneway houses, coach houses, secondary dwelling unit detached. They do go by a lot of different names. Lots of municipalities are coming up with their own definitions of what these are. But what you need to understand is that the province is now allowing them in your backyard. So if you're looking at ways to provide an additional living space, could be for one of your family members, maybe your in-laws, could be your parents, maybe it's to generate extra rental income. Take a look at your backyard space and see if you can actually fit one in there. You have to check your zoning bylaws for the setbacks and the size. And again, it's got to meet Ontario Building Code. To learn more about garden units and second suites and coach houses and laneway houses and all of these types of units, please check us out at LegalSecondSuites.com. And feel free to download the checklist as well at LegalSecondSuites.com/checklist. See you guys next week.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Welcome back. We are speaking to Anthony, who is our legal expert, and we are really covering everything that needs to be taught to somebody at home right now about real estate investing and what you need to know from a legal standpoint. I know in the beginning we talked about buying, contracts, all that good stuff. Let's talk a little bit about the seller's point of view. What are you seeing today?
So from the seller's standpoint, obviously there's a little bit more nervousness. It's, as we described, a buyer's market, or we've definitely moved into a more balanced market. So sellers aren't used to necessarily having their house sit on the market for a while longer, than say 7 days, or that there's not a bidding war for their home and so forth. So you know, the important thing is just A, to stay calm, and B, not to rush into anything. So buyers are going to come in now with various different sort of clauses and things that they need done, and you're going to have to accept some of it. But as a vendor, the things you can do, and the most important thing is be upfront and be honest. It's crucial that, you know, when you're into a stage now where what we haven't seen in 10 years, where people are back doing, you know, inspections and things, you might as well tell them things up front, because at least that way they're going in eyes wide open and there really are no surprises after the inspection. I've told some of my vendors that it might be in their best interest to actually do their own inspection, to know what's going to come up ahead of time, and to have that inspection available to any potential buyer. It does save those 10 days, but it is at your expense as opposed to the buyer's expense. So you have to be prepared to do that and live with whatever the findings are. You may be prepared to fix some of them, and that's fine, but I find that that transparency at the outset definitely helps. And that's number one. Number two, be very careful with the buyers when it comes to their financial viability. You don't want your deals not closing because they couldn't get a mortgage, or, you know, whatever that case may be, where there was a qualification issue that should have been taken up front. So allow them that financing time. And ask them too, when they made the offer, if they've already been through the process with their mortgage broker or bank with respect to financing, so that they know exactly where they sit. I am seeing, unfortunately, because you know, when you see shifts in market like 2007, 8, 9, or, you know, 2020, 21, 22, while we saw through the pandemic values and properties go up, after the pandemic, I think almost, you know, across the board, we're seeing the value stagnate or decrease, coupled with increase of interest rates. And what happens is these buyers who, even 6 months, 10 months, a year ago, who could have very well qualified no problem at 2.5%, aren't going to qualify, say, at 4.5% or 5% with the bank. And it's time for closing, and they can't close. And what do you do, and how do you do it? And so we are seeing an uptick for sure in people looking to the private mortgage market, whether it be through mortgage investment corporations, individuals, or companies that have money that lend on real estate, but it is expensive. So from a vendor, you really have to have a sense of the market. If you're going to price your property, I think you need to price it reasonably. Gone are the days of either pricing too low or too high, hoping for the result you want out of that, whether it be lots of people coming in on too low or somebody biting at the too high price.
Yeah, absolutely. A lot of information that I think is very important, especially as we're going into this, you know, unknown, likely for, I'm gonna guess, maybe a year or so, right, with everything that's happening. So I do want to go back to when you're seeing more things not close or maybe get delayed, and you know, the private lending route is maybe a backup. But what happens though if somebody does go firm, and between the time that they go firm to closing, they just can't close?
Right. So the basic tenet of the law is this: you, as the breaching party, so the person who causes the problem, the person who can't close. So let's say it's the buyer. You are responsible to the vendor for any and all losses that arise as a result of that breach. What does that mean? That could mean simply that the vendor has to resell the home and they sell it for less and you have to cover the difference. But it could get more severe if the person you're buying from is buying from somebody else and there's a chain and it goes down. What ends up happening is all the way down, there's a responsibility, and the buck will stop with the individual who caused that chain. In this instance, in this circumstance, the vendor. So what happens? Well, people think and are misguided that, well, the deposit is there and it's mine the minute they breach. That's not the case. Unless both parties agree to mutually release that money, it will sit in the real estate agent's trust account or the lawyer's trust account, depending on the nature of the deal. As a result of that, you have to maybe go to litigation if they don't agree. And so you're now embroiled in all kinds of issues with respect to that. But it can get worse, right? Because maybe the deposit doesn't cover the loss, and so you have to go through the litigation otherwise, whatever the case may be. We haven't seen much of this in the past because, well, frankly, values were going up.
Yeah.
But with values going down, and when people miss the mark especially when they're hitting the peak of a market, it can get really ugly. So what happens? Generally speaking, what I've seen is they'll ask for an extension initially, right? And at that time, it's prudent as a vendor's lawyer to ask for an additional deposit to show good faith, whatever that may be. I try and get double what is already there, but you work within the means of the individual, the buyer. Because in the end, there is a duty to mitigate all damages by all parties, right? Which means the vendor, if these people say, I can't close, you got to get that property back up and listed right away, and you got to figure out how to get best price. But the seller also has to do their best to help you in that process, right?
Of course.
So there's all kinds of things that could happen. One thing that I'm seeing more often now with lawyers, they say, fine, we'll grant you that extension. But if by that extension date you can't close, any deposits that are being held by anybody are immediately released to the vendor. And generally speaking, not as damages, but as the cost of doing business. We are seeing that more and more because it does provide an impetus for the buyer to ensure they close. And the problem is, from the buyer's perspective, when you have a lawyer who comes to you and talks to you like that and says, this is what we want, you don't have much by way of negotiating power. So in a lot of times, you have no choice but to acquiesce or agree, or at that point, call it at an end, not provide any further funds, and face the litigation that's going to come if there's a loss. If the vendor has no loss, he cannot look to that buyer to enrich himself any further, right? So it's important to understand that it's only for the remuneration of loss. It is not to benefit or to profit.
Right. I mean, I think it's just really important to involve, if that could be the case, or somebody thinks that they may not be able to close, to involve somebody like you right away in the process, so you could provide them some guidance.
Generally speaking, by the time a buyer or a seller realizes they can't close, they've already engaged counsel, and so we're dealing with it. Usually it's within a week or so of closing, which gives the buyers all kinds of anxiety, and it can be really problematic. But I will say this, the buyers especially who have done their homework ahead of time, I have lots of buyers who just refuse to buy, say in and around January, February of 2022, because they just felt that maybe that was going to be peak of some market. And I knew other people who did buy, and their properties have lost value or whatever the case may be. So due diligence, education, and really understanding the market that you're going into. I wouldn't go invest in a market that I didn't understand. I tend to stay away from stocks and bonds and allow other professionals to handle that because it's not what I do. I do real estate, I understand real estate, and so I feel that education lends better from the investment side for me personally.
Now, if you had to summarize, it could be something we talked about, or it could be something new, but 3 things that you want to make sure that, our viewers are taking away with them that's really important to know, what would those 3 things be?
Well, number 1 is what I always say when I come here. Every time I sit down with you guys, I always say it, and I said it today again. Education is key. Having the knowledge and being prepared will always set you up for greater success than otherwise. So it's vitally important that you understand the market, that you've talked to your professionals, that you have those people in place. Vital. Number 2, don't sign anything without talking to your professionals first. So you've educated yourself, you're ready to go, you have a contract in place. You need to make sure you've got your mortgage agent, your real estate agent, and your lawyer ready to go, and maybe possibly an accountant. And last but not least, don't fall in love with your investments. Stay reasonable and rational with respect to any investment, and if it doesn't make sense, walk. There will always be another one.
Great tips. Those are 3 key things. I hope that you took notes. And what is the best way to reach out to you if somebody on the show wanted to get some information or some more advice?
It's the usual, email or at the office. I'm always around. We have a great espresso machine, and I'm always happy to sit with clients and discuss their issues. A.O. Maniaca at msalaw.ca or 905-851-3400, extension 227.
Amazing. Anthony, thank you so much for being on today, providing some great insights. I'm sure you'll get lots of phone calls because there's lots of changes and people need to have that team of expert behind them, helping them along the way. So thank you for tuning in. Don't forget, we are back next week.